All right, in today's video, we are going to have some fun. We're going to look at using a whole life insurance policy to pay off a mortgage. This is a concept a lot of people are interested in. We get this question quite a bit. Hey, can I use my life insurance policy, particularly the cash value? Can I build it up and then borrow against it to pay off my home? The answer is yes. However, we do want to take a look and see if that actually makes sense. So this is based on a case study of someone who's had a policy now for 2 full years. They just started policy year 3. They've been aggressively funding the policy, but we're going to go through a couple of things. One, we'll see what they actually have in cash value. So we'll see the actual performance during the first and second year, what it looks like moving forward, and then we'll measure the performance of the policy and directly compare that with the loan scenario. So we can let the numbers speak to us and tell us, okay, this makes sense or it does not make sense. So to provide some details on the case here, we've got an age 40 female that she was 40 years old when she started the policy about 2 years ago. So she's 42 now, going on 43. But what she's interested in is using her policy to pay off her mortgage in full. And she's just about at a point right now where she can completely pay it off. That's what she wants to do. And a big reason why is because she doesn't want to have that obligation to a bank or to a lender of constantly making payments. She likes the idea of having that paid off and then being able to pay her policy back really at her discretion. The nice thing is too, where interest rates are, her policy loan rate is fixed at 5.66%, and that is a fixed rate, so it's locked in. Now, she started her policy 2 years ago, so we are going to review the actual performance. She's funding it at about $70,000 per year. It's a little bit more than that. She's funding right up to the MEC limit. And we recently had a review meeting. And initially, we had set this policy up to fund for 10 years. However, in discussing it and looking at how she's funding it, she's paying in more than what the original plan was, funding right up to the MEC limit. So it's performing quite nicely. But what she actually likes the idea of is instead of following the original 10-year plan, she can actually get a very similar dollar amount in over 6 years and then stop altogether. And as we looked at the different options, she saw that and said, I like that. That's what I want to do. Now, after that point in time, she can continue to fund the policy or she could start a new one. We'll look at that. But what she's interested in is really maximizing the cash value. And one of my favorite things to do with these products, if you design them to be flexible, is being able to do things like this, where I've got a plan initially, it was set up to handle $50K per year for 10 years. And from the first year, she's been paying in $72,000 and change, right up to the MEC limit, and the company has accepted the heavy payment. So it's worked out quite nicely for her. Now, her current mortgage balance is about $190,000, and she's presently paying $2,000 per month toward the mortgage. And that's total. That's with everything, insurance and everything involved. So what we want to look at here is one, a direct policy loan. So we're going to look at a policy loan of $190K, and then payment options as follows. One, what does it look like if I pay exactly what I have been paying on my mortgage, that $2,000, and pay that now toward my policy loan? Just to keep everything exactly the same, show me how much I'm paying in loan interest in this particular case, and then she can compare it with how much she's paying in interest to the bank. And then also an aggressive payback schedule. And what works nicely for individuals who fund policies more aggressive, when we see this aggressive payback, what you'll see is a scenario where after she has aggressively funded her policy for 6 years, which is what she wants to do, then she's going to redirect cash flow that she was paying toward premium and PUA payments and then apply that toward the loan. So we'll get to see both loan scenarios here. And then the main question is as follows. Do the numbers make sense? And what we're going to look at is what is the growth on the policy compared to the loan interest paid on the policy. Ready to have some fun? All right, let's take a look here. So what we've got first is as follows. Her policy. In fact, let's make this a little bit bigger because we've just got it on one sheet here. And this first measures the actual performance. So the first 2 years, you'll see it underlined here. This represents her actual cash values. We pulled these from the annual statements in the first and second year. So actual cash value and actual death benefit. So the first year, when she was 40 years old in 2021, she paid right up to her MEC limit. Her MEC space was $0.00, $72,000 and change. Cash value was $65,000 and change, which she paid in 72, had 65. First year's the worst year, took a hit there of about $6,800. So here we've got the cash value growth, and this will measure it on a yearly basis. And then here we've got the cash value gain, which will measure the total cash value gain over time. So for example, year 2, which was 2022, she again paid in the max. Her total payments are now almost $145,000. Cash value was 65 and change, grew to 138 and change. What that means is she got her full 72,000 and change back, plus another $530. So she's over the first year, which is fantastic. It just gets better from this point in time. However, we still need to factor in this. Year 2, I gained 530. Year 1, I lost 6,800, so I'm still in the red. And we'll see in this scenario, 2023, which she just started, her plans to continue to max fund it. Break-even point very close to year 3. Year 4, she's positive. When she's positive, you'll notice I'm no longer in the red in the cash value gain column. Then fund through age 45, that's policy year 6, does not pay a penny thereafter. In year 7, the premium's still due, but we exercise what's called a premium offset. That's more so on the agent's end. And then we illustrated a reduced paid up, which eliminates the premium altogether in year 8, which is why we see this death benefit drop here. But those are optional adjustments that we make that determination when that time comes. And we often show, here's what it looks like if you keep adding money, and here's what it looks like if you stop altogether. This way people can see it before they make a big decision like that. So this is beneficial because we see the growth. Simply, what does my policy look like when I pay money in and let it sit and grow? This, in my opinion, is so valuable to see before we look at loans. Because when I take loans, I want to see the direct impact that those policy loans have on my life insurance policy, cash value and death benefit. That's very important. So let's take a look first at scenario 1, which is the example where we're going to pay the loan off at $2,000 per month. Now, this is going to illustrate a direct policy loan. This policy is with Guardian, one of the major mutual companies. And what do we have here? On the left, growth. This is the same exact illustration we just looked at. So this is based on an in-force illustration with the exception of the first 2 years because those have already happened. If you've ever seen an in-force illustration, it will start in the policy year you're in. So year 3 is at the very top of the in-force illustration. Started the policy January 2021. Loan and repay. So she can take a loan in policy year 3. Just when I had run this illustration, the earliest we could run it was year 4. She can take it right now, no problem. Well, assuming she gets the full funding in year 3. As of the day of shooting this video, I don't know if she's done that yet. I know she aggressively has funded the policies and was eager to add more money, but I did not check it right before shooting this video. In any event, it doesn't matter. So here, we've got the $190,000. When that $190K is taken, we see the loan balance of $175 and change. Why it's $175 and change is because she's going to immediately take that $2,000 per month that she is paying toward the bank right now on her mortgage and redirect that toward the policy loan. So the $24,000, that's paid toward the loan. But look at this. A question comes up here. I took $190, my loan balance is $175, and I paid $24,000. So it reduced by a little bit less than $15,000 when I paid $24,000. Why is that? The reason why is because I've got this loan interest of just about 10 grand, 99.60. So the $24,000 that I paid first was applied toward the loan interest, and then the rest toward the balance, which brought it down to 175. Now, before we continue on here, as far as continuing year over year, look at this. When she pulls the 190, the cash value is my equity that I have access to. Whatever your total cash value is, that's the amount that you can borrow. A lot of times you'll see up to about 95% of whatever the cash value is with most insurance companies. Some are a little bit higher. But 118, before I took that loan, what was it? 293. How about the death benefit? So you took a $190,000 loan. Pre-loan, it was $2,225,000. Post-loan, $249 and change, call it $250. Why the difference? Loan balance is the difference. Whatever the loan balance is will be deducted from the death benefit. Sometimes loan interest will be accounted for in illustrations as well. But anytime I take a loan, the death benefit's collateralized dollar for dollar, and I also have to account for the loan interest that is paid to the insurance company. The last thing I want to look at here for policy year 4, when we take this loan out, is this column, annual cash value growth. What did I grow by this year? 71.41. What did I pay in loan interest this year? 99.60. Did I earn more or did I pay more in loan interest? I paid more in loan interest. Awareness is key here. Now, in her particular case, we also want to see, well, how much was I paying in loan interest to the bank, especially if I'm in the early years of the mortgage? Yeah, you know the answer to that question. However, as she continues to make the $2,000 per month payment, or $24K per year, we look at it year over year. There's the loan interest paid. Here's the growth in the policy. Okay, now I'm positive, assuming the dividend rate does not change and I continue on this funding schedule. We have to track the actual results as time passes. But in this example, we pay it back. There's the total interest paid, just about $55K. And what are the total gains at this point in time? It's year 14. $209,000, which is not really a fair comparison. It is because it's the numbers, but why it's not is because that gain is on my total cash value, whereas that loan interest was on an initial loan of 190. But this is the kind of stuff people like to see. I like to see it so I can see, all right, here's my total gains from using this product, and here's the total interest paid. Am I behind or am I ahead? Now, what I also want to hit on is this. Look at year 14 when that loan is paid back. What do you notice here? What was your cash value before you took a loan? 644 and change. How about after you took a loan and then paid it back? 647 and change. It's a little bit higher. Fun stuff, right? The reason why is because this is an older Guardian product. Well, it's not that old. It was started before 2022, before the 7702 update was applied or when insurance companies updated their products to comply with it. So we've got a loan interest rate, fixed loan, at 6%. The dividend rate is at 5.75%. So what happens, how Guardian functions, is whatever you have in cash value receives that 5.75 dividend rate. However, the outstanding funds, Guardian's a direct recognition company, still receive, so the money that's outstanding in policy loans still receive a dividend. What Guardian does, though, is adjust the dividend rate to match the loan interest rate, in this case, 6%. So there's a slight spread, 25 basis points based on a gross dividend, which is why I see slightly higher value here. Guardian's practice for a long time has been to apply a dividend rate that's equal to the loan rate. So if you look at new Guardian products, it has a fixed loan rate of 5%. So the same occurs. So we'd see the opposite in that case where the dividend applied would then be 5% if you're looking at a new product. But this is an older product, so it's important to mention that small detail there. I'd want to know. So here we go. That's a nice scenario. Let's wrap up with the aggressive pay down. So here, same scenario, growth on the left. There we go. But then loan and repay aggressively. Specifically, what we're going to do here is take a $190,000 loan, and the first year, pay just interest. So we're not applying anything toward the principal, like the last example we just looked at. Interest only. Years 5 and 6. What we're doing is paying the loan interest plus applying $24K per year toward the loan balance. And we do that through year 7. So this gives her 1 year of easier payments because she's aggressively funding her policy and paying the loan interest and applying $24K per year toward the loan principal. It's a lot of cash flow she's putting out, which I think she can handle from her conversations and such. She likes to aggressively pay things down. But in this example, year 7, just assumed, okay, let's take our foot off the gas a little bit. Let's recover before we run the next lap around the track. And then during that year, when she's not aggressively adding funds, she'll be able to stockpile more cash and then just pay the loan off altogether. She can do it however she'd like. For this model, I just assume that because it's cool to see different what-if scenarios. And because she's paid it back faster, what do we see here? Well, we paid less in loan interest. The last example was over $50,000. Here it's about $35,000. The same time, there's my total gain, $68,000 and change. What you could also look at if you'd like, let's put this in a different color. There's my out-of-pocket loan interest each year. 1 year, too long, and I can compare that every year with what the policy is growing by. The last layer to this would be to take the exact schedule from her bank, which we could run on a calculator too, to see what she's paying in interest to the bank, and then compare, okay, how much am I saving in total interest by executing this strategy, or if I keep it fair at the constant repayment, just of the same thing, $2,000 a month that I'm presently paying toward my mortgage, if I just shift it over to the policy. But in any event, her plan is to aggressively pay it down, so it does work out well for her, especially when you add the emotional piece that she just wants that mortgage paid off and doesn't want to have to think about it anymore. With the policy, you've got more control, meaning you can pay it back however and whenever you want. You don't have any late fee notices or saying, please pay now. You're not working with a bank. So that part was very, very appealing to her, and she's done a good job just building up her cash value. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. Let us know if you have any questions or comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.